Hello and welcome to our conversation on cost, and our discussion continues on understanding the cost. In this session, we will try to take an example and understand the cost in different presentations of computation of the cost. Suppose this is the information given. A business was started with 100,000. They availed loan of 300,000. They used the money to purchase a plant, the life of which is 10 years. And let us assume that the business was started on 1st April. They purchased the raw material 50,000 units at the rate of 5. Wages paid for the month 10,000. Office rent 10,000, factory rent 15,000. You can see several expenses are incurred. 18,000 is the factory manager's salary, office manager's salary 20,000, sales manager's salary 25,000 per month. And by spending all this amount and this material of 50,000, the company produced during the period 1,000 units and sold that entire stock for at the rate of 500 rupees per unit. At the same time, they also purchased shares worth of 20,000 and sold it during the month for 21,500. So lots of information is given, but by observing this information, it's not possible for us to tell us what is the cost. Of course, this information can be used to convert them into financial statements, but our objective is to find the cost sheet. In the process, find the cost of this 1,000 units. Now observe something, let us make some assumption. So 50,000 units of raw material used to produce 1,000 units of output. That means 1 unit of output requires 50 units of raw material. Because there is no other information is given about the inventory, so we are assuming that entire 50,000 units of raw material used to produce 1,000. And entire output is also sold. So this is an example where there is no inventory, no inventory of raw material, no inventory of partly finished goods, and no inventory of finished goods. Now let us convert this information into cost sheet. So the cost sheet looks like this. The direct material is 50,000 into 5, that is 250,000. Direct labor is a wages, so 10,000, and there is no direct expense, so the summation of this is called the prime cost or direct cost. So the prime cost per unit of output is 260 rupees. And the total prime cost is 260,000. Prime cost is also called the direct cost. Add the manufacturing overheads. That means overheads incurred in the factory. So factory rent, factory manager's salary, and depreciation. 15,000 rent, manager's salary 18,000. And depreciation, we can see that the cost of the plant is 300,000, but that is an asset. You cannot put entire 300,000 into the cost sheet because your cost sheet will only show expenses, will not include the cost of the asset, but will include the cost of using the asset called depreciation. So depreciation in this case is 300,000 divided by 120 months, because 10 years into 12, 120 months, and this is for 1 month. So therefore we are taking depreciation for 1 month. The summation of this will give us the manufacturing overheads. So prime cost plus manufacturing overhead will show the cost of manufacturing or cost of production or manufacturing cost, whatever name you are comfortable with. So 1000 units produced, the manufacturing cost of is 295,500. So per unit manufacturing cost is 295.5. And we are now going to add non-manufacturing overheads now, which is office rent, office salary and salesman salary. The total non-manufacturing overhead is 55,000. So the cost of sales is cost of production plus non-manufacturing overhead is a cost of sales. No inventory of raw material, no inventory of work in progress, no inventory of the finished goods. So therefore PC plus MO plus NMO will give us the total cost, which is, we call it cost of sales. So the cost of sales is 350,500. And the 1000 units produced, so per unit cost is 350.5. Now all these goods are sold at the price of 500. Price is given. We are not fixing the price. Later on in some other example we'll also try to fix the price, determine the price. So 1000 into 500 is a sales. Therefore profit is a sales minus the total cost. But will this profit tally with the profit as per income statement? Obviously no, because we are not recognizing interest. We are also not recognizing income from other sources. So we will see the difference between income statement and cost statement a bit later on. But observe the cost sheet. Cost sheet does not recognize interest and the profit on sale of shares. Does not recognize the asset, but it recognizes the depreciation on the asset. So therefore, this format, is it statutory? Answer is no. But this is an acceptable format of presenting the cost sheet, which captures the flow of cost from the prime cost to factory overheads, to the admin overhead, and finally to the point of sales. Now we will use this information to understand, to say that we can observe that the total cost of this product includes the prime cost, includes manufacturing overheads and non-manufacturing overheads. So depending on the question, depending on the situation, you can actually analyze this information and examine this information. Now let us try to put some relevant information, some more information to make the cost sheet more meaningful. Okay, let us go down and see here. All information is same, except that here instead of 1 month, this is for a quarter. Okay, the rest of the information is same. And one additional information is given. During the first quarter, we produced 3,000 units, because every month we are producing 1,000 units. So for 3 months, 3,000 units. And we sold only 80% of the stock. So that means 20% of the stock remained unsold, which is closing stock of the finished goods. If there is a closing stock of the finished goods, if there is an inventory of finished goods, opening stock and closing stock of finished goods, that needs to be adjusted after calculating the cost of manufacturing. So cost of goods manufactured, add opening stock of finished goods, less closing stock of finished goods will give the cost of goods sold or manufacturing cost of goods sold. Let me take you through once again. So for 3 months, for the quarter, so raw material 750, that is 150,000 into 5. Labor 10,000 into 3, 30,000. No direct expenses. The summation of this is the prime cost. Add manufacturing overhead, factory rent 15,000 into 3. Manager's salary 18,000 into 3. Depreciation on the plant 2,500 per month into 3, 7,500. So the summation of manufacturing overhead is 106,800. So the cost of goods manufactured is 886,500. Cost of goods manufactured per unit is 886,500 divided by 3,000 is 296. Because there is an inventory, it is necessary to understand the impact of inventory. Cost of manufacturing, current manufacturing, add opening stock of the finished goods, which in this case there is no opening stock, was not given, it's a new business. Less closing stock of the finished goods, it says 80% sold, so 20% of 2,000 remain as the finished goods. The value is not given, but the cost will be, the value of this, the cost of this finished goods will be 296, because that's what we have with us. So my 3,000 minus 600 is 2,400. So the corresponding cost of the closing stock will be deducted. So the cost of goods sold or the manufacturing cost of the goods sold is equal to 709,200. Then add non-manufacturing overheads, manager's salary, office rent, salesman's salary is the summation of that is a non-manufacturing overhead. So manufacturing cost of the goods sold plus non-manufacturing overheads will give us the cost of sales. And since 2,400 units are sold at 500, because the price is given, so the sales is 1.2 million. So profit is equal to sales minus cost of sales. Now the point to be driven here, or the important to be noted, is the adjustment for the opening stock of finished goods and the closing stock of the finished goods. If there is an inventory, it has to be adjusted. But since there is no opening stock, you are not able to see the impact of opening stock on the total cost of goods manufactured. So depending on the information available, we can keep on improving this cost sheet to make it more and more relevant. The final one, let us take an opening stock information also. Suppose all other things remaining constant, if there is an opening stock, all others are same. Raw material, labor, expenses is a prime cost plus factory rent plus manager's salary, depreciation is a manufacturing overhead, and the cost of manufacturing is 886, no difference. But unlike the previous one, here we have both opening stock and closing stock. So if the opening stock is 800, okay, and the closing stock is 600, assuming that is given. So therefore, add opening stock less closing stock will give me the units sold. Units sold is equal to current production. Units sold is equal to current production, okay, is equal to current production current production plus opening stock minus closing stock. Okay, so unit sold is equal to current production plus the opening stock minus the closing stock will give me the unit sold. So unit sold is 300. But here we observe by default we are assuming the FIFO method of inventory valuation. That means the opening stock is sold first, then the current production is sold. So unsold stock is from the current production. How will you show that? You can see that the current production cost is 296 per unit. So 600 units remain unsold. We are valuing it at 296. That means the closing stock is from the lot which has come from the current production. So if there is inventory, make adjustment of that on the cost at the relevant level. If there will be an inventory of raw material, make adjustment at the raw material stage. If there is an inventory of the work in progress, make adjustment at the cost of production level. If there is an inventory of the finished goods, then adjustment should be made after the determination of cost of manufacturing to determine the cost of the goods sold. So cost is a systematic way of presenting the cost data in such a way that it becomes useful, meaningful, relevant for decision making. Will this be part of financial account? No. No annual report will show the cost sheet. Cost sheet is not shown on the financial reports or annual reports because the GAAP does not require you to show the cost sheet. So understanding cost requires you to understand the purpose for which you determine the cost. That will dictate the method of deriving and determining the cost. Thank you very much.